How do strategy parameters affect backtesting a trading plan? Imagine trying to navigate a new city without a map or GPS. You might get lucky and find your destination, but more often, you'll take wrong turns or miss better routes. The same idea applies to testing a trading plan. Strategy parameters are like the settings on your navigation system. They guide how your trading strategy behaves. These settings include entry and exit rules, stop-loss levels, profit targets, how much to invest in each trade, and timing factors. Changing any of these can significantly alter your backtest results. For example, if you set a moving average crossover strategy, the lengths of the short-term and long-term moving averages determine when you buy or sell. Using a shorter moving average might generate more signals, leading to more trades. But that can also mean more false signals and higher transaction costs. Longer averages might produce fewer signals, but those signals could be more reliable. Adjusting these parameters changes how often and when your strategy triggers trades. Parameters also impact key performance metrics like total profit, maximum drawdown, win rate, and the reward-to-risk ratio. If you tighten your stop-loss, you might reduce losses on each trade but could also get stopped out too early, missing out on bigger moves. Looser stop-loss levels might increase potential gains but also risk larger losses. Setting higher take-profit targets can boost profits but might also lead to more missed opportunities if the market doesn't reach those levels. Another important aspect is how you optimize these parameters during backtesting. If you tweak them too much to fit past data perfectly, your strategy might perform poorly in real markets. This is called overfitting. To avoid this, it's best to test parameters across different market conditions and multiple securities or options contracts. This helps ensure your strategy isn't just tailored to past noise but can handle future changes. Timing and confirmation signals are also affected by your parameters. For example, how many signals you wait for before entering a trade or how quickly you act after a signal can influence your ability to catch trends or avoid false alarms. If you're too slow, you might miss big moves. If you're too quick, you might get caught in whipsaws. Position sizing parameters determine how much you risk on each trade. Setting these correctly helps balance risk and reward. For instance, investing a fixed percentage of your capital per trade can protect your account from large losses. Scaling in or out based on market conditions can also improve your overall performance. In practice, testing a range of parameter values systematically helps you find a good balance between profitability and risk. Incorporate realistic assumptions about transaction costs, slippage, and liquidity to make your backtests more accurate. Using walk-forward analysis or testing on different time periods and securities can validate your choices. Diversifying your backtests across various stocks or options contracts prevents bias toward specific sectors or market environments. In the end, your strategy parameters shape how your trading plan behaves during backtesting. They control when trades happen, how much you risk, and what targets you aim for. Carefully choosing, testing, and validating these settings is essential to develop a plan that performs well in real market conditions, whether you're trading stocks or options.